Ghana has added 10.7 billion Ghana cedis to its public debt stock in just 4 months. And the details, July 2020 to November 2020, that's this month. Government is generally attributing the persistent increment to the COVID-19 pandemic. Now, our total debt stock has seen a sharp surge within a span of 11 months or so, from 204.6 billion cedis in January 2020 to a whopping 273 billion cedis in November 2020. So how did we accumulate the debt? There's more in this report.
Before the COVID-19 pandemic, Ghana's total public debt stock stood at 204.6 billion Ghana cedis. By March ending, the country's debt stock had increased by 31.5 billion Ghana cedis. Between January 2020 and July 2020, Ghana's debt shot up by 28.5%, pegging the country's debt stock at 263 billion Ghana cedis in July. Prior to the COVID-19 pandemic, the World Bank and the International Monetary Fund had expressed worry about the nation's rising debt levels, saying it poses challenges to the fiscal economy. What this means is that if the debt levels are not checked, it will get to a stage where the nation might struggle to settle interest payments, particularly when the cedi begins losing grounds against the US dollar. In that case, you will need more dollars to settle the loans. Ratings agencies Fitch and Standard & Poor's have also expressed similar concerns, warning it could affect the nation's credit ratings. Well, Ghana is expected to pay about 24 billion Ghana cedis on interest payments for this year alone. This will be a little over 4 billion Ghana cedis, what was settled in 2019. Last year, interest payment cost the nation about 19.756 billion Ghana cedis on loans. Already, the IMF is forecasting the country is likely to hit 74% debt to GDP ratio in 2021, given the current 71% debt to GDP ratio as of November 2020.
Joining me via Zoom, Peter Quarte. He's a professor at the Institute of Statistical, Social and Economic Research and joins us for more. Hello, Prof. Thank you very much for your time. Good afternoon. Now, the IMF has cautioned government about the nation's rising debt levels even before COVID. What measures do you think that government put in place to reduce the borrowing rate even before the pandemic? Because most of the time we've been told or we've been referred to the pandemic as the cause of our rising debt stock.
Yeah, good afternoon to your discerning viewers, and thanks for inviting me. Certainly, before the pandemic, if you notice, our debt GDP ratio was below 60%. There have been quite a few policies that government put in place. There was debt restructuring, where some of the high-dated or expensive debts were redeemed for cheaper debt and many others, because the debt is comprised of the stock as well as the interest payment. So that really worked. And also, we borrow to finance investment, so we grow. So as our GDP kept growing, our debt GDP ratio kept coming down, or was at a level that was acceptable. It is unfortunate that we are currently at where we are, but we are not in that situation alone. You will find UK, US, South Africa, and many others, Mozambique, many other countries with very high debt GDP ratios. We are at a risk of debt distress, but we haven't reached the distress stage where we are unable to service our debts. But for me, the key point is, how did we use the funds? I think we need to be more focused about how the monies were used. If we haven't used them, we haven't borrowed to use them or invest or spend on such items, would it have been appropriate? I think that should also be the focus of our discussion.
And so I want to come to that before I even move to my question, which feeds into the debt distress that you talked about. From where you sit, in terms of what we have used for this, the loans that we've taken, how, do you think we've used it in the right way? Because most of the time we're using it to actually service other debt.
Well, certainly, to a large extent, I would say yes. Certainly, we need to service previous debts. You can't say I won't pay. You certainly have to service previous debts. But also, some were even used to ensure the financial sector cleanup, the bailout that we saw. about 21 billion was spent to clean up the financial system. If we hadn't done that, the government hadn't done that, you can imagine the number of people who would have lost their lives, the number of people who would have been ill, still terminally ill, and the repercussions on the economy. Because if you affect one person, that can translate into other livelihoods as well. So that aside, we saw the coronavirus pandemic and all the devastating effects. There's the need for intervention, and we saw free electricity, water. Of course, these are temporary measures. I don't expect government to continue to do this going into 2021. These are temporary measures that we should gradually ease off some of these freebies and then ensure that we spend money on capital expenditure. Our roads need to be fixed, our hospitals would have to be fixed, and many other things.
Yeah. Fair as it may sound there, let's take a look at the servicing of debts that we have had to do. Now, Ghana is expected to pay about $24 billion, 24 billion cedis on interest payment for this year alone. And that will be, that we're looking at a little over $4 million. Hello, Prof.
Yeah,
can you hear me?
The interest payments has severe repercussions on our ability to spend. It reduces our fiscal space to be able to invest in capital expenditure. If you even review the budget statement that was submitted by the Minister of Finance for the first quarter of 2021, you realize that about 25% of that request will go into debt servicing. And that is quite huge, that's significant. Once you pay salaries and other compensation and also statutory payments, we are left with only close to 7% for capital expenditure. When in ideal situations, we need to be spending between 15 to 20% of our monies or investing in capital expenditure, we are only doing 7%. So that cost is a cause for concern. But of course, we find ourselves in the pandemic era, and I am hoping moving forward, we'll gradually move away from some of this social spending and then divert funds into capital expenditure.
Again, on the same issue of servicing debts, last year alone, interest payments cost the nation about 19.756 billion cedis alone. So are we not better off, avoiding piling the debt stock, because this money obviously could have been used for other social interventions which would be beneficial?
That's the ideal situation. I mean, we have what we term the pecking order hypothesis, where people prefer own funds, internal funds. When you exhaust that option, then you move into loans and other things. But unfortunately, our domestic revenue mobilization has not been sufficient. Our tax revenue as a proportion of GDP is about 15%, way below the African average of 18 to 20%. So it tells you there's a gap that has to be filled. If we are not raising enough money domestically, it means we have to find means of financing the gap. That is why government resort to borrowing. We could have avoided these interest payments. Unfortunately, we don't have the resources. We are a developing country, even the advanced countries borrow anyway. So the best option would be to borrow, but borrow responsibly. Borrow and invest as much as possible so that you'll be able to recoup returns. It will yield the needed returns, we create jobs, and then we'll be able to service our loans. But if we borrow to consume, that will be a recipe for disaster for us.
Will it be fair enough to say that the country is likely to experience the 74% debt to GDP ratio by the IMF in 2021? That's 2021, given the current 71% debt to GDP ratio as of November this year?
That will depend. I mean, the explanation or the intuition given was that the bonds that are going to be raised, part of it will be used to redeem old debts. And if we, of course, we're able to grow our economy better, then we may be inching towards the 74, but we might not get there. So it depends basically on how much we borrow come 2021 or from now to 2021 and how much we're able to grow the economy. If we're able to grow the economy at a faster rate, granted that now we are opening up quite rapidly, and then granted that we're able to manage the spread of the virus, then our GDP will grow. So our debt GDP might not hit 74%, but I don't expect anything below 70%.
Let me finally ask what your thoughts are as far as the effect on the country's currency and the economy in general would be going forward.
Well, the currency has been quite stable, and I think we must commend government and the monetary authorities especially. The challenge is more of a fiscal issue than the monetary sector. So if we are not able to manage our deficit very well, then we might not experience any severe repercussions on our exchange rate. So far, the CD has remained relatively stable. But if our deficit go beyond the expected, that might create problems. That might create unnecessary risk to our economy. And then there might be some capital flights after the elections if we don't manage some of the macro indicators. If that happens, then certainly it will have repercussions on the exchange rate. But if we're able to spend reasonably and manage the deficit, then that situation might not arise. Our exchange rate will continue to remain stable.
Hopefully, we'll get there. Prof, thank you very much for your time. Professor Peter Quartey, there is a professor at the Institute of Statistical, Social and Economic Research. They're helping us understand our debt stock, what we've done, what we can do going forward.